Hi, James Good here with an On the Money market update on Sunday, July 15th, 2012. Now this is an update to my July 10th video, which looked at an exceptionally rare price pattern in SPY, which had just formed the prior 2 days. Now you'll remember that in August of 2008 I discovered how 2 straight months in the Dow, which opened and closed below a 2-month moving average, was a strong hint of an extreme in selling pressure which was not likely to let up. The market had taken a major shellacking after this signal in 6 out of 7 similar instances since the 1920s. And we then looked at a not dissimilar type of example of scenario on the daily chart, where sellers had pushed the market down so hard that 2 consecutive days price action took place entirely below a 3-day exponential moving average, even while the market itself was in an uptrend. Now this had happened just once before in 20 years, back in 1994. The theory being that once again that it showed major players were liquidating with unusual urgency and that the pressure would continue, and sure enough the market did sell off sharply over the next several days. Well, things went pretty much to plan Tuesday, Wednesday and Thursday, and the market dropped steadily until Friday. We had a huge up day, 1.5%, wiping out those falls. So the question has to be asked, is that it? Is it up and away to new highs? Well, I've looked at a number of standard technical indicators and not so standard ones of momentum, breadth, volume and sentiment over this weekend in the hope of finding a clear answer. Annoyingly, there doesn't seem to be one. The signals are, I'd say, mixed with perhaps a bullish tint. So I thought I would look instead deeper into this curious price pattern and see whether it can still give us any kind of edge. So I decided to lower the bar slightly and use a 4-day EMA in order to get a larger number of instances of this same phenomenon. And I also decided to check whether the pattern is as effective intraday on a 60-minute chart, because obviously if it's valid, the principle should hold good whatever the time frame. So we'll come back to the daily chart in a moment, but here is 10 years worth of hourly data, the number of 60-minute bars in 10 years being equivalent to 60 plus years worth of bars on a daily chart, so this should be a pretty robust test. So I looked for instances of 2 consecutive bars whose entire action fell below a 4-bar exponential moving average, while not falling entirely below a 20-bar simple moving average. Remember, we're looking for sudden heavy selling pressure during an uptrend. There were 28 instances in 10 years. 24 quickly led to a lower low. Now a couple of them just fell off a cliff and never looked back, but most staged some kind of a rebound within the next couple of days after the signal. These examples are from the rally to the October 2007 top, and they're fairly typical of what happened next. Few more bars selling, an attempted rebound, and then a new low. Many of these rallies looked highly convincing as they were happening, and yet 24 of the 28, that's 86%, fell to a new low soon after. Most fell pretty much straight away, but the maximum delay in those 25 cases was 14 trading days. Here are the latest 3. Perhaps just as interesting was the fact that 3 of the 4 exceptions occurred during very strong and well-established uptrends when speculation was rampant, which is hardly the case here. 2 in late 2003, 1 in October 2010 in the teeth of QE2 mania. The other was in October 2002 during the blast-off phase of that bull market. So this does seem to give us a valid edge, at least on an hourly time frame. So how about the daily chart? Same criteria, and this time 13 instances in 20 years, 11 of which have produced a clear result. The latest 2 from the last few weeks, these are still in play. But of those 11, 8 produced the same kind of outcome as we saw in the 60-minute chart. A very short-term rebound beginning within a few bars, and then a sell-off and a lower low. And the longest it took to reach a new low was 25 days. And again, of the 3 exceptions, 2 were in strong, obvious speculative uptrends. So no guarantees here, but the risk still seems to be to the downside.